All right, let's talk about one of the most powerful and honestly, one of the most secretive forces in the entire global economy, private equity. You've almost certainly used products or services from companies owned by a private equity firm, probably without even realizing it. These firms, PE firms for short, have completely reshaped huge industries, everything from healthcare to retail, all while staying way out of the public spotlight. So, what's the secret sauce? How do they march in, take over these massive companies, totally transform them, and then sell them for incredible profits, usually in just a handful of years? Well, that's exactly what we're going to break down. Okay, so before we get into the nitty-gritty of their deals, we've got to start with the basics. Who are the people involved in this world, and what's the ultimate prize that they're all chasing? First things first, let's clear up a common mix-up. Private equity is not the same as venture capital. VCs, they're betting on brand new, unproven startups, right? PE firms, on the other hand, they target companies that are already established, already mature. They're not trying to find the next big thing. They're trying to take an existing big thing and make it way more profitable. So, the PE world really has four main groups of players. First, you've got the limited partners, or LPs. Just think of them as the money. These are huge institutions like pension funds or university endowments. Then you have the general partners, the GPs. That's the PE firm itself. The famous names like KKR or Blackstone. They're the ones managing all that money, with their fund managers running the deals day to day. And last, but definitely not least, you have the banks, who provide the gigantic loans that make this whole thing possible. So how do these general partners, the PE firms, actually make their money? It all comes down to a really simple but powerful formula called the 2 and 20 rule. They charge their investors a 2% management fee on all the money in their fund every single year. But the real jackpot, the prize they're all after, is the 20. That's a 20% cut of all the profits they make from a successful deal. This creates an unbelievably powerful incentive. Find a company, make it more valuable, and you are going to cash in big time. Of course, it's a bit controversial because that 2% fee often gets charged no matter how well or how poorly the fund is actually doing. Okay, so now we get the motivation. Let's look at the main tool in their toolbox, the machine they use to generate those massive profits. It's called the leveraged buyout, or LBO, and it is the absolute heart of the private equity world. The easiest way to wrap your head around an LBO is to just think about real estate. Let's say you buy a house for $1 million, but you only put down $200,000 of your own cash. The other $800,000, that's a mortgage from the bank. You then spend a little time and money, fix it up, and sell it for $1.2 million. You pay the bank back its $800,000, and what's left? $400,000. You just doubled your initial investment of $200,000. That's the basic idea. And in a typical leveraged buyout, you see that exact same logic, but on a massive scale. The PE firm might only put up, say, 30% of its own money. That's their equity. The other 70%? That's borrowed from the banks. By using all that leverage, they can control this huge company with a relatively tiny investment, and that is the key to supercharging their potential returns. But here's the thing, all that debt isn't just about juicing the returns. It actually serves a really important strategic purpose. The idea, which was pioneered by the academic Michael Jensen, is that having to make these enormous debt payments forces a company's management to be incredibly disciplined. There's just no room for wasteful spending or pet projects. Every single decision has to be about one thing, generating cash to pay back those loans. So, the PE firm has bought the company using an LBO. Now what? Well, the clock starts ticking. They typically plan to hold on to the company for about 4 to 5 years, and during that time, their entire goal is to make it as valuable as humanly possible before they sell it. To do this, PE firms really pull on two main levers. The first one is called margin creation. This is the hands-on stuff, making the business actually run better and become more profitable. The second lever is multiple expansion. Put simply, this just means selling the company for a higher price relative to its earnings than what they paid for it. It's kind of like improving the company's financial story to make it look way more attractive to the next buyer. Both are important, but these days, there's a much bigger focus on making real, genuine operational improvements. So what does creating those margins actually look like? Well, the playbook is usually fast and pretty aggressive. It often starts right at the top by bringing in a brand new leadership team that's obsessed with efficiency. From there, they might sell off parts of the business that aren't central to the mission. And then they'll refocus the company's entire strategy on whatever it does that's most profitable. It's a complete overhaul, all designed to make the company leaner and more valuable in just a few years. Okay, after 4 or 5 years of intense transformation, it's time for the grand finale, the most important step of all, the exit. This is the moment the PE firm finally gets to cash out and realize all that profit. And they've got a few standard ways to do this. They can sell the company to a direct competitor, that's called a trade sale. Kind of weirdly, they can also sell it to another PE firm, that's a sponsor-to-sponsor sale. Or they can take the company public through an IPO, an initial public offering. And a newer, faster option that's popped up is merging with something called a SPAC, basically a shell company designed to buy other companies quickly. But here's the thing, that classic LBO model we've been talking about isn't the only game in town anymore. This industry moves fast, and as more money has flooded in and competition has gotten tougher, their strategies have had to evolve. And you can see this evolution really clearly when you compare the different kinds of deals they do now. Besides the classic LBO, you have things like PIPE deals. That's private investment in public equity. That's where a firm takes a smaller minority stake in a public company just to give it a quick shot of cash. And then there's growth equity, which is sort of a mix between PE and VC. They'll fund the expansion of a fast-growing company, usually using very little, if any, debt. So the big takeaway here is this. Private equity has moved way beyond just being a financial game of buying with debt and selling for a profit. Now it's about getting deep into the operational nuts and bolts of actually running businesses. And as their strategies keep changing and expanding, it leaves us with a really fascinating question to think about. Where is this massive, incredibly influential industry going to turn its attention next?